Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Afternoon, folks. Hi there. Welcome to another episode with Vantage Point with True North Wealth Partners. Episode number 39. Today is Monday, October 23rd. So a lot to go through today. We're rounding the corner, looking into a pretty sunny day and a fall weekend. The colors are beautiful here in Ohio, so I hope you're enjoying the fall weather as well. So with that said, we're going to dig in a lot of visuals, going to warn you. So I do have a lot of visuals. I'll do my best to just educate. This is a very informative video podcast, a lot to cover. So running solo today, the crew's all out, running around, doing client meetings, etc. So on behalf of Andy, Eric, Russ, Jim, Stacy, and myself, again, as you know, always please reach out to us. We're here for you. I know you get touch points throughout the week for your emails, our publications, our video podcasts. Please subscribe, hit that red button on the YouTube channel so it's easy for you to just follow us automatically as these get released. And check out our website as well, because there's plenty of other information, blog and charts and things of that nature too. So it's always evolving, and we're looking forward to keeping that updated with constant information too, because we cover so much. So with that said, let's get right on into it. So with that, I'm just going to hold this up briefly. If you can see this. So this is just basically coming from Schwab on one of the calls. We have plenty of research partners that we utilize. This is going through the economy. So just in general, just so you're aware, the recovery stage, kind of like coming out of the pandemic, then you have the expansion stage, then you have the slowdown, which is what we're into now, just starting now, okay? And then the recession. So think of the economy like a sine curve, okay? Everything follows through a sine curve. There's ebb and flow, market cycles. So the good times are over, so it's going to be buckle up time. And you're starting to see that now heading forward. So I wanted to visualize that for you, just so you're aware of sort of what to expect over the next 2 to 3 quarters. GDP. So earnings have started for the third quarter. They are being released. Earnings, for the most part have been okay. But let's now talk about, that's old news. That's, third quarter news. We're into the fourth quarter, pretty much at the end of October. So two months left. So let's talk about GDP. So GDP gross domestic product, will be released here, I believe, on Thursday. So Hedgeye, one of our research partners, they're projecting a positive 3.12% GDP growth rate. Other economists and institutions are looking for a stronger, over 4% GDP growth rate. So whatever it is, the point is this: it's going to be north of 3% GDP growth rate. Great, okay? The first 2 quarters were positive. Q1, Q2 were positive. Q3 would be the highest. And then you're going to see, strap in folks, some flat to possibly negative GDP growth rates being printed for Q4, which will be printed and released in January of next year. Q1, flat to negative, and even possibly flat in Q2 of 2024. So these next 3 quarters are going to be the depth of what we have been calling the rolling recession. Is finally going to turn into a mild recession, full blown. Okay. So mild recession, it's this rolling recession, no more artificially being propped up. The last proppedness by the government was the ERC credits, the money flow to the business owners, giving tons of money. The government actually cracked down on that because a lot of fraud was going on. So that kept the upper to middle class to upper and the business owners really spending heavily. But that too has come to an end. Along with, like we talked about the podcast, is student loans repay, snaps being cut back, things of that nature. So just wanted to sort of give you a forewarning of what's to come. So this week will be a volatile week in both directions in the markets for the S&P, both up 50, 60 points, down 50, 60 points. We saw a little bit of that glimpse last week. So the S&P 500, it did cross a 50-day moving average, and it also crossed a 200-day moving average. Support lines around 4,200. So when it crosses, the S&P goes lower than 4,200. You violated that line. It happened on Friday, and it happened today, this morning, intraday. The S&P was down. It crossed below 4,200. The risk range from Hedgeye was 4179. So you could expect the S&P 500 to hit 4,179 today, intraday. So they always publish risk ranges. So I have an understanding of what the market's going to do day to day, volatility wise. So anyways, so strap in. And I personally, I will be selling off about 3 funds this week, most likely, or it could be the next week as well. But anyways, this week or next week, just reducing the beta. So there's a couple small cap funds, some things that I have. I just want to reduce that beta, knowing what's coming. So Andy and I, we've built portfolios. We're just putting basically a little bit more airbags for what's coming. So he has his accounts and et cetera, and all the other guys as well. But just knowing, you guys know I'm actively trying to stay ahead of the markets and what's coming. So that's what we're doing. That's why you hire us, to stay ahead of what's coming, the blind spots around the turn. So with that said, let's get into the mortgages. Okay, mortgage rates. Mortgage rates basically hit 8% on Friday, last Friday. First time since 2000. So not good. Treasury yields have soared over 5% for the 10-year as well. And just to sort of give you a visual, so you can watch this. Nathan, our producer, does a great job, so he'll be showing you this. This talks about basically existing home sales. So you can see going back to 2014, the height of it, and then it goes back down. Right now we're doing 4 million sales, and it's near the lows of 2023, of last year. So we had a reversal. Things were great, coming back down. So existing home sales are slowing, okay? And then you can see interest rates. They were 3% 2 years ago, and now they're 8% as of last Friday. So 3 to 8, okay, you can see that as well in the chart. And what that means monetarily for you all, to put this more to sense. So for every $1,000, as the rates went from 3 up to 8%, which was 2 years ago, it's now costing borrowers, household folks, and the mortgages $1,000 more per month. So that is pain. That is definitely hurting people in the pocket. So just wanted to sort of visualize that for you, but also monetize it. So yes, housing is not affordable, is basically what it comes down to. So I just wanted to make you aware of what's going on in the housing market and interest rates. Going on to, again, just referencing our Hedgeye, another research, the firm that we use primarily. Volatility. So the 10-year crossed the 5%. Last week we talked about that. In addition, the 30-year, like I mentioned, highest levels. The fixed rate is over there. But I'm going to talk to you about the steepening of the 2-year, 10-year. So again, when you see this is a very busy. So there's a lot to take in here. So just take your time and go through it slowly. So with that said, looking back to the 10-year, 2-year, the delta, the inversion here. So, earlier this year, it was well over 1%, 108 basis points, 108 basis points was the difference between the 2-year, 10-year. So meaning you're going to get more yield on a 2-year than you would a 10-year. So why would you go long in the yield curve? Why own a 15, 20, 30-year? Stay in the short end. So that's what all that means. So it's bounced off that. And then what I'm trying to say is focus on the low points of the blue line and then see how the recessions in the shaded gray column, the gray column. So once you see the treasury spread narrow, So now it's around 0.17 on this graph, but it's actually 0.11, I believe, right now. But anyways, as it narrows, that just means, okay, it's normalizing. The yield curve is normalizing. The back end's now getting higher, going higher and closer to the 2-year. So as it normalizes, then it goes positive. You see, get above the red dotted line there, it goes positive. Then you'll see going back in time, that's when the recession starts. Okay, so with this rolling recession, it's going to turn into a recession here, and we're in it now. It's officially it's going to start peel back the layers of the onion. You're going to start seeing it over the next 2 quarters here. So there's a nice visual for that, and I just wanted to visualize it. That comes from Hedgeye and the Tier 1 Alpha team. So I'm on their calls daily. They produce some awesome information, and basically, this is a quote from them. I will read this. The steepening has historically meant the wolves are at the door and the recession is here. So again, when that blue line gets close to that zero flat line, when it's steepening back up to normalization, that's when you enter really into that recession. So again, we don't see it being like the .com or 08. It's not going to be that deep. But yes, it will be a shallow / normal type of recession. And easily the S&P could be down 12% over the next 2 quarters here. So yes, you heard that right, minus 12% on the S&P. Okay, so just we're preparing, and we have been, but also just preparing for what we see coming. Good news is you won't be experiencing that negative of a drop because of how we build the portfolio. So now moving on to the magnificently manipulated 7, the MM7. So those are the Facebook, the Meta, Microsoft, Google, Alphabet, all that good stuff. So those 7 stocks really have been holding up the index, S&P 500 index. So with that being said, the S&P 500 is up over around 10, 11% year to date. Okay, take out those 7 stocks, and the S&P is flat year to date. And then if you just take the S&P 500 and you equal weight it, and not cap weight, equal weight the S&P 500 index, you're negative over 3.5% year to date. Again, minus over 3.5% year to date. So that's what we've been trying to caution and educate you all on. It is not a normal year at all. You have a very select few, narrow few propping up the stock market, and everybody's saying on old wall TV, oh, the consumer's fine, everything's fine. No, it's not. So you're finally going to start to see that evidence really portrayal, stuff that I've been following and seeing all along, but you're going to start seeing it more on the mainstream old wall media. Okay. Another way to look at it. Okay. This is a great chart. Nathan will hold this up as well. This is pretty cool. So with this, it just shares about those magnificent 7, like we talked about. And the bottom line is the S&P 500 index. Okay, it talks about the PE ratio. So the bottom line is the S&P 500 PE, price to earnings ratio. Okay, so it's around 18, 19 times right now. The top line, going back to January 2023, you can see month to month, you can see the top line. Okay, it was 29, dipped to 27 PE ratio for the Magnificent 7. Okay, and then you can see it right now. It's closing on 46, 47 as a PE ratio, price to earnings ratio for those 7 stocks. It's ridiculous, the disconnect. That's why I wanted to visualize it for you this way. Amazing, again, what's going on there. So hopefully you'll enjoy that visualization too. We talked about the quads, the quads, 1, 2, 3, 4, spring, summer, fall, winter. We're coming last month out of quad 2, which was briefly. Now we're into quad 3, which is now the stagflation. So you'll see that stagflation little meme there. So with that said, just means the economy is slowing, inflation will be sticky. So yes, it has come off the high point as far as the overall CPI, the PCE. That's what the Fed prefers that one to watch. Again, the PCE, that's going to be coming out here on the Friday. So they want it to be near 2%. It's not, we're going to be anywhere near 2%. So it'd be higher for longer. So, let's talk about the Fed. November 1st is a Fed rate hike possibility. The last meeting is on December 13th of this year. So 2 more meetings, two more possibilities that the Fed may raise rates 25 basis points. They may not. It really doesn't matter at this point. The point is the economy's slowing, the damage is there, and it's all going to be unveiled. So that's why we're just going through that. And then also, not to mention what the slowing economy, but basically the S show, as you know, as I call it, the three-ring circus. But as you can see here, you got the world events, which was predictable. When you got bad policies, both here and abroad, I've been saying that for 2.5 years. This is what the outcome. So that was easy call. Economy, easy call. And then politics, it is what it is. So, whether it's a Great Recession, whether it's the Great Reset, whether it's what have you, call it what you want to label it. It's just America's under siege. So we have a lot of things to fix under the hood here. And, that's why we adapt. So we adapt the markets, we make the portfolio changes. So that's why we're doing the best we can as the signs and signals tell us. We want to stay ahead of what's coming to minimize the market losses that you all may see. So with that, we'll then, this is again a little technical, but remember I talked about the 0 days to options expiration. Here it is. Got a nice chart from my research relationship with Tier 1 Alpha that I use. So I'm on their calls. They do a great job. Mike Green, shout out to him. Appreciate his efforts. Met him personally, and he does a great job, and his team. So with that said, take a look. Stop and really focus in on this, folks. So go back to 2018. Okay, 0 days to options expiration. So these are just S&P 500 options, daily intraday changes that the options. Instead of the VIX, it's a 30 days going out, okay? 30 days, now it's just 0 day. So these institutional traders are now really, really manipulating the markets daily, fast, intraday. Like today, Monday, the S&P broke 4,200 and it went back up to almost 4,300. I mean, over 4,250 or so. So it just moves a lot. You're going to see more and more. And when that dam breaks, you'll see S&P down over 100 points easily intraday in either direction or up 100 points. So market movements are going to happen faster. So going back to the chart here, again, let's call it, if you take that as the orange line in the middle, that's the 0 day up as a percent of the total volume, sort of in the mid-range there. It's called 10, 15% going back to 2018. And then you can see how it moves up. So they're paying more and more credence to manipulating the markets. And right now, basically, this is coming from the Tier 1 Alpha group from last week. Basically, I think it was last Thursday, over 54% of the SPX, which is the S&P 500 options volume, was from 0 DTE contracts. Okay, that's right around the record level. So you can just see a handful of blue lines where it's elevated near that 54%. So near record level, 0 days expiration. And basically just keep in mind that around 85% of this volume is being driven by dealers themselves who are hedging their own book and their positions without ever engaging in the futures markets. So there's going to be a lot coming down, I believe, with the SEC looking into the 0 days expiration here over the next year, because they are taking advantage of there's an opportunity gain there. And so they're manipulating it to their ability, and they're getting a leg up, and the folks get whipped around in the mindset where they make tons of money intraday. So this was a great graph. I've been waiting to get something like this to share with you visually as to why I said the game has changed, I think forever, just because unless there's other regulations that could possibly come in. So that's on that. So let's sort of end here, folks, on tips of the month. So with tips of the month, there's a few of them, so bear with me. But hopefully you found this episode pretty engaging, a lot of information there. But on the tips of the month, so basically, PSA announcement, public service announcement, winterize your car at home. So I just got my car done last week. So make sure you winterize, tire pressure, change all that good stuff, fluids topped off, windshield wipers, all that good, what have you. So I'm a car guy, as you know, so that's my little PSA for taking care of your cars. Home, also do the hose bibs, blow out your sprinkler systems, whatever you got to do. So just take care of the home, change the filters, did that. I drained the water tanks as well. My girls, I show them how to do it. So help those boys My girls know more than the boys, I bet. Anyways, number 2, basically people are going out to eat earlier than they did pre-pandemic. Okay. So this little chart, Nathan will put up. So it's pretty interesting. So it talks about the times of the day people eat. This is just something different, but I have a good friend of mine who's in the restaurant business, and it's just interesting to see. You can see the time period from 2019 pre-pandemic versus now in 2023. It's up 2%. People, the chart shows up being 2% more people are eating at 5 o'clock than they were pre-pandemic in 2019. So they're going out earlier. 6 o'clock, increase of 1% versus pre-pandemic. 7 o'clock sort of flat. Then the 8 o'clock is going down by 2%. Fewer people are eating later. And then 9 o'clock, again, down by 2%. Fewer people are eating later. So a lot of that, especially a late night, is just really has to do is the nightlife, late night in the major cities. It just isn't what it used to be. As we know, that's sort of self-explanatory. That's saying it nicely, self-explanatory of the country's changed. It's just a lot of craziness out there. So people don't want to take the risks. And people are working at home too. So that also leads to why people are going out earlier to get away from home, having, maybe happy hours earlier, et cetera. So I just thought that was an interesting factoid. This is coming from Neil Howe from our Hedgeye partner. So Neil Howe, our demographer. All right, that was number 2. Part 3, telework. Like I said, worker occupancy rate. From the Workplace Occupancy Barometer, office buildings in the 10 largest U.S. cities were only at 49.8% full occupancy for the week of 10/11. So the week of October 11th, 49.8% of office buildings are being occupied full. So again, it's come off the lows, obviously, but not near anything like it used to be. So hence, that's why you don't see any real estate, malls, office buildings, things of that nature in our portfolios. So we don't use that because that's the next leg to land in 2024 and into 2025. So, and last, this is pretty cool. Nathan may like this one. This is DoorDash. So DoorDash is targeting gamers. Okay, so here we go. So DoorDash has a new eyes on its customer base here, and it's the gamers, because hardcore gamers, have been utilizing their services over the last 2 years. DoorDash has sponsored competition for streamers. They've been advertising the gaming conventions, things of that nature. So with that said, their tagline is stay in your game. That's their tagline. So it's working. Since April and June of this year, 12 million gamers who've played for an hour or more daily have now ordered from the app. That's double the number who ordered in the first 3 months of 2021. So again, the upshot's this: people who are gaming, they're ordering from the app, it's working. So there might be longevity risk, good side, upside for DoorDash, knowing that they're trying to capture another pool of market folks there. And then lastly, as a reminder, the COLA for Social Security is 3.2%. Cost of living adjustments, 3.2%. You'll see that in January. But people forget, and this is the silent little death, is the, every year we keep on getting hit with more and more taxes. And it's this Social Security payroll tax. So years ago, 5-6 years ago, it was $105,000, 110, 115. Okay. So last year it was $160,200. So 160, 200 was the wage base. Okay. This year it jumped from 160, 200 to 168,600, 168,600. That's a 5.24% decrease in your income, folks, for 2024. All right, folks, so that was a tips of the month. Hope you enjoyed that. Now we're going to end on some charts. You know me, I'm a visual, love the charts. So let's get right into it. Enjoy. So the first one here is the stock market price to earnings ratio, the PE ratio. So as you can see, tech bubble is 24.5. That was the high. Average historical PE ratio is 15.6. It was over 20, right around 20, 21. And recently it's around 18. So that's nice to see it's coming back down to reality. And so I like to always point that out. Earnings. Okay, earnings for the S&P 500. So you can see how it's, to come off the highs over the past few years. Historical average for the earnings growth rate is 7.7. And right now the latest is, negative 0.8. That's the earnings for the S&P. So we do not see things getting any easier for the next couple quarters here. So just strap in for some earnings to be tapered. The VIX, Volatility Index, that's the S&P 500, okay? So the VIX used to be more useful, but the 0 days expiration, that's really taken over the VIX. But I still like to look at the VIX once in a while. And again, the average is 18.6. Last week it hit 21.7. And again, just to keep things in reality. So the VIX traded for, it was below 20 for 101 days. So that was like I forget the top 5 longest period for the VIX being below 20. Again, 101 days it was below 20. And it just broke that last week. So that tells you something. What's more important, and having worked in the fixed income department at T. Rowe Price in Baltimore, Maryland there in trading pits. So the bond, it's called the MOVE Index. So the MOVE Index is the volatility for bonds, what the VIX is for the volatility of the S&P. So check that out. So on the MOVE Index, the average is 85. Okay, right now it's 135. And you can see how high it was during the pandemic. And then of recently spiked back up over 200, came back down near 100. Now it's back up to 135. So the bond market is usually a leading indicator, a better predictor of what the stock market, how it's going to react. So that's why I always keep an eye on the good old MOVE bond market index. Annual returns and pullbacks. So you can see S&P up over, a little over 10%. It was down. The lowest point was minus 8%. The average drop market loss for the S&P is minus 13.5%. Okay, even though the market's still on average or end in positive territory, you can have wide swings, so drawdown. So just be aware you're going to have that volatility. And again, the volatility is of 5% pullback. Now it's up to 2. So 5% pullbacks in the S&P is now at 2, and the average is 4.6. And you can see last year we had 12. Interest rates, we talked about the 2-year, 10-year spread. Okay, so that's tightened up. But just check that out, how the rates just skyrocketed here, 2022, 2023. So the 2 years over 5%, the 10-year, it hit over 5% as well. So that gap is narrowing, becoming uninverted. And, when that happens here on this next chart, the yield curve steepness, the 10-year, 2-year yields, the recessions are shaded. So as that narrows up, 0.14, 0.11, as it gets back to flat 0 and positive, that's then when the recession occurs. And you can look back at the past, handful of our recessions, and it's come down low, comes back up. This is a nice way to look at the 10-year minus 2-year and the inversion. And so we've been inverted, and now we're coming out of it. And like I said, the wolves are at the door. U.S. economic growth. Remember the GDP, quarterly GDP. First quarter was positive 2.2. Second quarter positive 2.1. Third quarter, which will be announced later this week, will be over 3%. Could be close to 4. Doesn't matter. It's old news. Fourth quarter, and then first quarter, second quarter will be flat, possibly negative. So what matters is what's coming up. The average historical yearly GDP growth rates there is 2.8. And again, it's what the future holds is what's a little unnerving. And then leading economic indicators, again, they're still shaded, minus 7.8. So these indicators turn negative several months before recession as the economy decelerates. Remember, we're slowing down now, and then will be for the next few quarters. So again, to strap in, and these are always leading, and you can see the recession. The gray columns are shaded in. Once it's negative, for the past 7 recessions, they've always indicated you're in a recession. So yes, this will turn in from a rolling recession to a recession, just not a deep one, just more of a shallow / normal one. So we're all over it. We're watching it for you. Personal savings, Personal savings, you can see the high point was during the pandemic, 32% personal savings rate. That's incredible. The average is 6.3 is historical average. People can hold back for savings. Currently, it's 3.9, and it's gone down of rate. You can see it going up, the little curve there. I wrote in there ERC. That's the ERC money went to the employers here over the summertime. So it was the Fed, the government manipulating the markets again, trying to keep the economy going, keep that party going for as long as possible. But now that too has now, the money supply is now tapered out. So we're all coming back to reality. So it's draining it back out. So that was a temporary fix, sugar high, and it's coming out. So strap in, folks. We appreciate you all. I know that was a lot, but reach out to us. Again, if you have any questions, concerns about what's coming, but know that we've put some more airbags in, and we're going to keep that up. There'll be some volatility. There'll be good days, bad days, but we're looking at more than just a month or a few weeks. It's months and quarters and into next year, because you'll see a lot more. And again, you've heard it here first with Vantage Point with True North Wealth Partners. All right, take care, you guys. Enjoy fall. Talk to you later. See you next time.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal.